Investment considerations for the RMD portion of income. This goes back to my man Wade Pfau and Joe Tomlinson and Steve Vernon's spend safely in retirement strategy from Stanford Center of Longevity. And this is, I want to share this with you because this is interesting because they're going to divide it up in a couple of different ways here. And I think it's important for you to understand. So I would just use Wade et al. So I'm just going to use Wade. But they write, significant allocation to equities increase expected retirement income and also volatility in income. All right, so here's the scenario. To illustrate the impact on the RMD portion of income of different equity allocations, we prepared stochastic forecast, random, of the annual real RMD income amounts. We developed line graphs showing the annual real retirement income over the retirement period for the following percentiles, 90, 75, 50, and so on. The projections for a married couple, both 65, with $400,000 in their portfolio. Now, they're using a couple different assumption sets, which is critical. To demonstrate the possible range of real investment returns and real retirement incomes, remember, real just means after inflation, we use two sets of assumptions. Assumption one is forward-looking real returns averaging 5% per year for equities and 1% for intermediate government bonds. I'd even argue that's probably on the high end, but be it as it may. Assumed annual inflation rate is 2%. All right, so that'd give you a 3% return on government bonds, and right now that's it's not even anywhere near that. So basically, before inflation, after inflation is 1%, because the 10 years is like 1.5. All right, but either way, the assumption set reflects a current low interest rate environment and economic environment. So basically, what Wade et al. Are saying is we can pretty much, with a real close assurance of what government bonds are going to give us in terms of returns. Stocks, not so much, but stocks with a higher PE ratio, i.e. Higher valuations, will give us lower returns than historical averages. I completely agree with that without question. But then the assumption set number two is they're going to use historical returns averaging 9.04% for equities and 2.25% for government bonds. Again, this is real data. Assumed average inflation was 2.97. And this goes back to Dave Ramsey thing of 12%. So you got 3% inflation, 9% stocks. That's a 12% nominal rate of return. 3% inflation, 2.25% for bonds. That's a 5.25% nominal return. After inflation is 9% for stocks and 2.25% for bonds. All right, so let's see what we got here. Remember, a retired couple, $400,000 in their portfolio. The median real withdrawals by age, varying the stock bond mix, forward-looking for returns. So forward-looking returns, again, is 1% on bonds and 5% on stocks. And so we're just taking the RMDs out here now, and we're adjusting each and every year as RMDs increase in the table. And that's what this whole premise is built on. If you just take it with your RMDs, you're going to take a lower amount on the front end and a higher amount on the back until you start going into the principles pretty significantly. So the stocks are in the blue, 50-50 is in the orange, and the gray is just 100% bonds. All right, so as you can see, we're taking the first year's 3.75, which is literally the first year of RMD roughly. I mean, obviously a little bit different, but it's pretty doggone close, between 3.5% and 4%. It goes up, it goes up, it goes up, it goes up, until you get right there. You're getting $20,000, and this is the median, so half the time it's above that, half the time it's below that. And that's 100% stocks until you start going back down again. And when you're 100, you went back down from basically 21,000 or so down to 14,000. So you're starting at 13,500 roughly, goes all the way up to 20,000. That's a real rate of return, and then starts going back down to about 14,000. That's stocks. 50-50, same thing. You're starting the same premise, but instead of going up to 20,000, you don't get above about 17.5. We'll just say 18. And then it goes down to about 12, all right? So your real income is dropping pretty significantly as you get older, which is okay because your spending goes down, presumably. Yeah, the drawback I have is this little hump here because your spending at this stage is probably going down there too, and that's when you're getting the most income. So sacrifice some income on the front end, knowing full well that you have lease on the back end, but you don't care about that. But the most income you have is, when you're in your late 80s. And I'm not a fan of that. Anyway, some with 100% bonds, on the other hand, they start at $13,500 roughly on a $400,000 portfolio. And that gives us, we take our trusty calculator, that's roughly a 3.75 distribution amount, and then it slowly starts going down, down, down until we're just about $6,000 when we hit 100 years old. So that doesn't do much for me. You don't want the bonds, that's for sure. That doesn't do any good. All right, so now we're see the 10% real withdrawals by age. So here we're going to look at real annual return income under the 10% forecast for 3 asset classes: stocks, bonds, and 50/50. And this is where it gets kind of dicey. So if you're in the 10% threshold, i.e. you're in a world of hurt. So again, we have a median, 50% above, 50% below. But what if you're in the worst 10% threshold? Again, you start off with $13,750, roughly 3.5%, 3.75% on your 400,000, and then it just goes down. And you can see the stock one gets hammered pretty hard. Again, this is random now, so this says a random sequence of events on stocks, which is the blue, really set you back, whereas bonds held you above water for at least a little bit. But either bond, stocks, and 50/50, you're getting hammered. I mean, you never replace at all what you initially started with, which was $13,500. So stocks, within 2 years, you're down to, what's that, $8,000. Then just, within 10 years, you're down to, what's that, $7,500. And this is adjusted for inflation. And then down by your 100 years old, you're down to $4,000 or so. 50/50 would be your best portfolio. So 50/50 survived the best of the nightmarish 10% scenario, and yet on the median 50/50, 50% above, 50% below, 50/50 was much better than bonds and within spitting distance of stocks. In that regard, the risks versus reward, the 50/50 is probably the best scenario in the future-looking returns with a 1% bonds and 5% stocks. 50/50 is the way to go, without question, because it gave you the best when the markets went chaotically poor, and it gave you still pretty good when the markets did well. So on the median, let's just say, not well, but did on the median, because you got to remember, this isn't well, this is the median, 50 above, 50 below, and this is when it did poorly, 10% bad, the least 10% favorable. All right, now if we do a real annual returns using a historical method, though, the historical numbers, again, 9% in stocks, 2.25% in bonds. Again, this is after inflation. What you'll see is stocks just kicked butt and took names. I mean, we got 15,000 roughly, or 13,750. By the time we're 97 years old, we got $60,000. $60,000. This is the median. Again, this is historical numbers here. 50% above, 50% below. And this goes back to what Kitsis and some other guys say too. If you look at a median withdrawal rate, the median is roughly about 6%, not 4%, 6%. Half the time is above, half the time is below. And same thing here. For a median withdrawal rate, if you take, this is pretty spectacular. You're getting pretty good returns on your money in terms of withdrawals later on down the road. From a 50% stocks and bonds, is still pretty good, but not nearly as well as the historical for just the stocks. And that just makes sense because stocks gave you 4.5 times the returns on average every year over year, compounded than bonds did. And so you see the wide gap between stocks and bonds there. Going back to the 10th percentile, again, this is the worst 10th time, 10% of the times or less, I guess. Stocks still did better for the most part. Stocks and bonds we're fighting for whatever did better, but bonds did the worst, bar none, because bonds after inflation just getting hammered. The interesting thing is they don't talk about taxes here, and I do find that it's tough. It's problematic. I wish they give us a sample client here of a 65-year-old couple who with $400,000. Right, let's see, right here. The projections for a married couple with 65 with $400,000 at retirement. I wish they would have taken taxes out because, if you're taking $13,500 out in the front end and then you're going back until you're 83, 84, you're taking $20,000 out in real money, and then your Social Security is being inflated too. Taxes are going to play a role there. So I was surprised they talk about it. They said there's just too many variations tax policy, which I agree with. You can't. Not to look at taxes is leaving a lot on the table because the taxes are a net cash flow outflow. It affects your spending. So they're saying save spending in retirement, but it's not spending on you and your consumption. It's spending on you and your consumption plus taxes, and not to use taxes. You're missing out on about $5,000 or 3 or 4 or 5. I don't know what it is, but you're missing out on a significant source of your consumption for sure. All right, that's all I got on this. More to come. Here we go. Oh, so they're doing a comparison. Median withdrawals by age: 100% stocks. Historical returns is orange. Yeah. Oh, yeah. Look at this. That's crazy. 100% stocks historical is orange. You're freaking kicking butt and taking names. Forward looking in terms of 5% stocks and 1% bonds, and this is just 100% stocks. Much difference. Much difference. That's interesting to me. So if we're looking at historical, that's where the 4% rule starts shining. But if we're looking at what we think was going to happen in the future, not nearly as good. That's for sure. We don't know. But I mean, I think, can you split the difference? Yeah, probably. You could probably say halfway through. 50-50 bonds, historical versus future. It's a challenge, man. It's a challenge. All right, don't forget to smash, subscribe, hit the bell notification, share, and we'll see you next time.